Well, hi everybody, welcome. I wanted to thank everybody for being here today. We are going to talk about long-term care insurance from a 1,000-foot perspective. I know that for those of you like me, this topic is always looming in the background as we have many clients, residents, patients who own these policies. I, like many of you, understand long-term care insurance from my own industry's perspective, my lens, but not necessarily from the consumer's perspective. Our hope is that you come away from the presentation with a better understanding of long-term care insurance as a whole, of what it is, why it exists, what is happening now in the industry, and be given some resources to better help you, your own clients, residents, patients, families, or maybe even understand a policy of your own. And what better way to get that perspective than with Jenica Cassidy, our favorite elder law attorney. We are thrilled to have her here to give us this overview. Jenica received her law degree from Wake Forest and is a practicing elder law attorney in the DC metropolitan area, currently with Lerch, Early, and Brewer in Bethesda. Her practices focuses on guardianship, long-term care planning, and crisis situations to secure a payer source, estate planning, and probate. She's a frequent speaker and author, presenting and writing on guardianship issues for the National Aging and Law Conference, the American Bar Association Commission on Law and Aging, and the Elder Law Journal. Jenica was recently named a 2021 Rising Star by Maryland Super Lawyers and named a 2021 One to Watch by Best Lawyers in America. And before I forget, there will be an opportunity for Q&A. So in our Zoom meeting, there is a chat box. Please use that to type in your questions during the presentation. Don't be shy, we're all here to learn. We will aggregate them, and the lovely Bree, who is from our parent company, Care Advantage, will be asking them at the end. Bree, thank you so much for running our PowerPoint and always making these Zoom calls so seamless. Finally, Jenica is going to mention a few resources during her presentation, so we will be sending everybody an email following the presentation with these resources, Jenica's information, as well as a copy of this recording. So that is all for me. Jenica, I think we are ready.
Thanks, Ariane.
Yeah.
Can you hear me? Great. Hi, thanks for that lovely intro. Thanks for having me. Hello to everyone. Hopefully we're all doing well. Hopefully we can turn our attention away from the election results for a few minutes to talk about long-term care today. So let's just jump into it. Let's get into the next slide, please. Great. First thing, as lawyers do, I gotta give a quick disclaimer that we're gonna be talking about some legal matters, but this is not intended to be taken as legal advice. All situations are unique. Certainly that's the case when it comes to long-term care insurance policies. I'm not your attorney, but if you have questions regarding a specific policy, you should feel free to reach out to me or an attorney of your choosing. Alrighty, next slide. So what is long-term care? What is long-term care insurance? Long-term care, broadly speaking, it's the personal and medical care needed by individuals who become disabled, whether that's due to age or certain health conditions. About 70% of people who reach the age of 65 are expected to need some form of long-term care at least once in their lifetime. And just a bit of background here regarding the industry. As some of you may know, it's in a major state of flux right now. These insurance agencies who sold all these great policies back in the 80s and the 90s, they realized in recent years that they got they got the algorithms wrong. Turns out folks are living longer than they expected. They're generating higher medical costs, greater expenses. it's a major problem. So a lot of these agencies have gotten out of the market entirely. A few stats just to run by you. While more than 100 insurers sold policies in the 90s, now less than 15 do, which is pretty crazy. Since 2002, or excuse me, in 2002, 750,000 new policies were issued. In 2018, 2 years ago, only 56,000 policies were issued. So this is the new reality that we're working in. Insurers they're trying to salvage the market in some ways. They're offering various hybrid policies, which we'll talk about a bit later, but it's not great news because long-term care, as a lot of us know, especially skilled nursing, it's expensive. And the vast majority of it is not covered by Medicare, not covered by private insurance. Remaining options are really limited. Private pay, Medicaid, which of course is needs-based. You essentially have to impoverish yourself to qualify. And long-term care insurance. So sorry about that. That's where we're at. Next slide. What's covered? Good question. Long-term care insurance provides coverage for people with chronic illness or disabilities who need assistance with ADLs, activities of daily living. Usually it's at least 2 ADLs. As many of you know, ADLs are everyday tasks such as bathing, toileting, eating, dressing. This is folks with dementia, folks recovering from surgery, those with physical inability to care for themselves, et cetera, et cetera. There's really no one-size-fits-all answer here. Policies provide coverage for a really wide range of in-home and institutional services. Assisted living, continuing care, adult daycare, nursing care. Some policies, I don't see many of these, but they offered services for informal family caregivers, some ambulance reimbursements, things like this. Those aren't really common, but getting specific under, I practice in Maryland and DC, so I'm going to reference Maryland and DC law solely in this presentation. But under DC law, long-term care insurance is defined as any policy that provides coverage for at least 12 consecutive months for at least one necessary service in a setting other than an acute care hospital. Same definition in Maryland, except it's for at least 24 consecutive months. And then digging into the specifics of it in Maryland, an individual must require assistance with 2 ADLs or must suffer from severe cognitive impairment for at least 90 days. The law also requires, unless there's a pre-existing issue, it must provide coverage for Alzheimer's or other dementia disorders without any condition or limitation or reduction in the coverage. And then also in Maryland and in DC, the insurer can only cancel or refuse to renew. These are guaranteed renewal policies. So they refuse to renew the policy for non-payment of premiums or some sort of fraud or material misrepresentation in the application. All right, next slide. What's not covered? So there's a few things to consider here, and of course they vary greatly depending on the terms of the policy. But first, foremost, if the insured is not eligible under the terms of the policy, they're not going to trigger the need for benefits, meaning they don't need assistance with ADLs for a set period of time, and they don't have cognitive impairment. Second is the elimination period. This is the period of time that the policyholder pays out of pocket at the beginning when services are first needed. This can range from 0 days, which is great, up to 90 days, even 300, a full year, depending on the policy. And I don't think this is the case in Maryland, but there's other policies where the period of time can differ for nursing home care versus home care. In some policies, they require the insured individual to satisfy the elimination period each time there's a new need for care, and others only require that they satisfy it once. And the way that the elimination period is counted it's different. There's a couple different ways here. One is calendar days. So a calendar day waiting period, it's the number of calendar days you're eligible for benefits before the plan's going to pay. And then there's service day waiting period, which is the number of days you're eligible for benefits and receiving and paying out of pocket for that care that's approved by the care coordinator before the plan's going to pay. One of the nice things is that under some of these plans, like the federal long-term care program, services are covered by services that are covered by Medicare, they can be applied towards the waiting period. And then anything under the federal long-term care program, and I think it's also some other policies as well, that's once you're eligible for benefits, the waiting period does not apply while you're receiving certain types of care. That includes respite services, hospice, caregiver training, I believe. So these services, they're covered during this period of time, but they don't count towards meeting the waiting period if the policy is that service day waiting period. But it's a nice thing to know about because there's a lot of folks in this area that do receive their policy through the federal program. Something else not covered, or something to be aware of: the benefit period, the period of time the policy is going to pay out the benefits. Usually ranges from 2 to 6 years. Oftentimes it's 3 years. Lifetime coverage is generally not available. Some policies allow for a restoration where the benefit period, it can resume after it has run if the individual is in a recovery mode. And then all policies have specific exclusions. A few of them are coverage for mental health conditions, anxiety, depression, OCD, care received outside of the US, coverage for alcohol abuse, drug abuse, self-inflicted injuries, service care provided by someone in the individual's family. These are specific exclusions that are usually applicable under most policies. However, in Maryland today, policies issued today, they can't force the individual to have a prior hospitalization requirement before gaining eligibility. Or the condition eligibility for benefits, they can't force it to be based on previous higher levels of institutional care. Okay, next slide. How are these benefits paid? So again, it varies. As many of you know, the policy may pay a specific fixed amount for each day of service, regardless of the actual cost of the care, or the policy may reimburse the individual for various actual expenses accrued up to a certain amount. Some policies are going to pay directly to the provider. Some policies are going to pay to the policyholder, who then turns around and pays the provider or pays beforehand. And there's some policies that provide a pool of funds, which is kind of nice. It allows the policyholder to get a per diem maximum. It's like generally the nursing home reimbursement rate, or like a portion of that reimbursement rate, that it can be used in any setting: home care, adult daycare, assisted living, nursing home care, any setting up to a per diem maximum. Alrighty, next slide. Hybrids. So the hybrid policies, they're a combination. They combine limited long-term care benefits packaged with another financial product. It's usually an annuity or a life insurance policy, and they've become quite popular both because of what I mentioned earlier about the industry changing so rapidly, and also because folks there's the whole use it or lose it risk with long-term care insurance, right? So they like the concept of, with these policies, you're able to pull from the death benefit to pay for long-term care while you're still alive if you need it. And any unused benefit is going to be paid out to your beneficiary at the time of death. So there's a guaranteed return of premium in some form, whether that's via the death benefit or long-term care, or perhaps even both. And so it eliminates that use it or lose it risk. Another perk that folks like is that the premiums can be locked in from the initial purchase date and they don't increase, which folks like, but they're not really for everyone. Some in the industry like to tout these as like the best option out there, but I'm not sure if that's really necessarily the case. There's a big disadvantage, of course, is the cost. They're expensive up front. And also they're often funded with a one-time premium payment up front, and there's no inflation protection, which in other policies, there is inflation protection. It's usually 5%. It can be lower. I don't know if I've seen higher, but 5%. Because if you buy this policy and then 30 years later you need to use it, costs are going to be different, right? So if interest rates rise, the provider is under no obligation with these hybrid policies to pay the going rate of return. So the benefit 30 years after you buy it, ultimately paid out, could be much lower than what's actually needed to cover the cost of care. I don't know if a lot of folks think about that or are aware of that, but it can be substantial. Okay, next slide. Premiums. First, I'm going to give you a stat. The average annual long-term care policy premium in 2000, $1,600. Now it's about $2,800. So do they increase? In short, yes, premiums can and likely are going to go up or have gone up. They will go up. And this is a primary reason why only about 12% of people over the age of 65 have long-term care insurance. However, there's some protections in place. The law limits what insurance companies can do. So before raising costs, these insurance companies must show that the rate increase is needed to cover future claims. Remember, going back to what I said about them getting their algorithms wrong, they have to present to the state, to the insurance commissioner, that they need this extra funds and they need this extra cash in order to pay out future costs. So the premium, they've got to submit a request. It goes through a full review process. There can be a public hearing. They got to provide notice. You can, if you know your policy number, you can go online, type it in, and see if your specific policy is if it's in a review process for the premiums to go up. So it's got to be approved by the state insurance commissioner. Then importantly, once the policy is issued, the premiums can't be increased because of an individual's age or their declining health conditions. They can't single you out. The law requires that any rate changes must impact an entire class of policyholders. Excuse me, take a sip of water. So under Maryland law, in general, a long-term care insurer cannot raise premiums by more than 15% in a 12-year period, which is still substantial, but there are limitations to be aware of. Okay. Oh, sorry, go back. Do you have a choice? Does the policyholder have options other than accepting the premium rate increase? In short, yes. When you're notified by the insurance company that your rates are going to be, that your premiums are going to be increasing, they will give you options, and they're certainly worth considering. One option is to adjust the benefit period by shortening it. Another option is adjusting the inflation growth option by reducing it. If it's at 5%, dropping it to 3%, something like this. But certainly a good idea is to call the insurance company and ask them if they'll permit other options that aren't outlined in their notice. In Maryland, and I believe in DC, every long-term care insurance policy must allow the policyholder to reduce coverage, lower the policy premium by either reducing the maximum benefit or reducing the benefit amount, the daily, weekly, or the monthly benefit amount, whatever it may be. So you don't just have to automatically accept the premium increase. It's a trade-off that you need to talk with your insurance advisor and your financial expert and your attorney about. and weigh all your options. Alrighty, next slide. Filing a claim. So what do we need to know? File it as soon as possible. As many of us know, these things take time. You should begin I advise consumers to begin the claim process if you're receiving long-term care services, you've recently received long-term care services, or you expect to receive them in the next couple of weeks. And each insurance company has their own claim form to initiate the process. It's generally only the policyholder or a power of attorney that can file the claim, unless they've designated someone when they initially purchased the policy or in the past. And then the insurance company, they'll contact the care provider or the facility. They'll review the medical records. They have their own internal processes for determining if the services that are being requested are covered. So the important thing here is to clearly document everything. Make it as clear as possible what the disability is, what the limitations are of the individual, what their dependencies are, the type of care that's needed. Some policies ask for a certification from the individual's attending physician as to their level of dependency. So I recommend in those cases, treat it like like the physician is essentially writing a prescription for long-term care services. Just keep it as clear as possible. And then if it's approved, benefits, of course, they're not going to be paid out until the elimination period is satisfied. And then submission of regular invoices for covered services. This is either monthly or biweekly. The policyholder, they'll either be reimbursed for out-of-pocket payments or the carrier will pay the provider directly. If the claim is denied, the insurance company has to provide a written explanation. They've got to also provide you an opportunity to access all their information that they relied upon in determining the denial. And in case of denial, just regardless, I have a set rule. I document every call that I have with the insurance company. It can get to be a hassle, but I've kicked myself in the past when I haven't done it, and I've been glad to reference extremely specific notes. This is the name of the person that I spoke to on this day, and this is what they told me. And then I always try to follow with an email or a letter. I keep a running, just like a simple Word document that's easy to reference for when I need to follow up, when I need to nag them for pending requests, for pending claims. It can be difficult. If you're having problems or you feel that the claim was improperly denied or there was something done in bad faith or their due diligence was not done, the state can help. So in Maryland, it's the Maryland Insurance Agency, and in DC, it's the Department of Insurance, Securities, and Banking. And you can go online onto their website. I can provide this information and file a complaint with them for assistance. And I've actually had success with doing this. I did it most recently for a client where they were denied for services, and we just weren't getting any response at all from the insurance company to just a simple request for medical records. So if you file a complaint with the state, it shows the insurance company that you're serious about pursuing the dispute. They don't want the state on their tail. They don't want the regulatory people down their necks. So they're going to cooperate, at least in my experience. As attorneys, we're limited as if we're in litigation, we can subpoena for documents. There's ways to get information that we need, but if we're not in litigation, we're kind of at the helm of these large insurance companies, and it can be difficult to get what you need. And so don't be hesitant if you feel that it's appropriate to get the appropriate agency involved. All right, next slide. Can the insurance provider cancel a policy? So like I mentioned, they can't single the individual out. It's against the law for them to cancel a policy due to the individual's age, physical condition, mental health. A long-term care insurance policy can only be terminated in a few instances. Non-payment of non-payment of premiums, misrepresentation in the application, of course, if you've used up your benefits. Is there another slide? Is that the last one? Open for questions. I was talking with Ariane yesterday, and she brought up the question about what if the lapsing of policies. So I did want to mention that because the risk of a policy lapsing for lack of payment of a premium is a real thing. It's given the nature of this type of coverage and the cohort of people that it caters to, they could fall into this easily. So in Maryland and DC, the law requires the insurance company must notify the policyholder and any person that the policyholder designates to receive notice. They've got to notify them if they're going to terminate coverage due to non-payment. So it's usually about 30 days, 35 days after the missed payment is when they'll issue written notice. They'll mail it out. And the policy cannot terminate for non-payment of premium unless they send written notice at least 30 days before the termination. So a few things to highlight here. It's critical for these policyholders to designate a power of attorney or a trusted third-party individual to receive notice of default so that it can be cured quickly. And if they're in a position where they have a disability, they're you could imagine the situation that this comes up in, and you've probably seen them yourself. There's got to be someone else that they can designate to receive the notice. And of course, it's a good idea for them to set up auto payment. And if the policyholder stops paying the premium, some policies have a non-forfeiture option, which allows them to receive a reduced amount of the benefit that's based on whatever money that they've already paid into the policy. And then there's a grace period generally of about 5 or 6 months or so for if the policy does in fact lapse, for the policyholder to reinstate it, if they can show that they're cognitively impaired or they were disabled under whatever the terms of the policy require. And then specifically in Maryland, for some policies that were issued before 2003, if the policy lapses, the carrier must provide the policyholder a contingent benefit if the carrier increased the premiums, the policy is at least 20 years old, and the policyholder terminated the policy within 120 days after those premiums increased. So that's what I have. I'm happy to talk with folks about any questions they may have or.
All right. Hey, Jenica, it's Brianna with Capital City Nurses.
Hello.
We do have some great questions. This has been really great information, and I think some folks have some really good questions here for you. And so we'll just get started. I do want to tell you that Miss Deanna would definitely like that information about what agencies to file complaints through that you were speaking about earlier. So I think that would be great information to provide. So we have a question from Jeff. He asked, for a family member, often an adult child, who would coordinate the long-term care planning and insurance coordination on behalf of an adult in mental decline, what formal documentation, if any, is needed, for example, such as a power of attorney?
Yes, that's it. The power of attorney is crucial. If folks don't already have a power of attorney in place and they are a Maryland resident, I like to refer them, I'm also happy to send this out, I like to refer them to the Maryland statutory power of attorney. I believe it's available on the Maryland Attorney General website. It's a statutory form. About 10 or 12 years ago, the state kept running into, folks kept running into problems that they'd create a power of attorney, they'd go through the work of doing it, and then their agent would bring it to Bank of America, say, I'm this individual's power of attorney, let me have access to this account. Bank of America would say, whoa, we're not going to honor it because this isn't our Bank of America power of attorney. So, and it's a huge problem. And so the legislature passed a law stating that if you create a power of attorney per this statutory form, that they have it all laid out on their website, and you sign it, you do the appropriate documentation, you bring it to a bank or whatever financial institution, the long-term care insurance provider, they have to accept it. So it's a nice, in my practice, we have our clients, our Maryland clients, complete the statutory form in addition to a more broad, more encompassing form that allows for more powers that the statutory form doesn't have. But at the very basic, get them to do the statutory form. That's the power of attorney is the primary thing that you're going to need.
Good. All right, great. It's a good question. We have a question from Sean that is pretty interesting and probably has happened to several people before. If you have a policy that's underwritten by a company that is no longer in business, will anyone honor the policy, and do they have resources to service the policy holder?
Yes, they are supposed to provide you with notification of that, of the transfer, and they're supposed to, I know at least they're in the law because I just saw it, for pre-existing conditions, they are not permitted to change the terms regarding coverage of pre-existing conditions, and they're supposed to provide you with comparable coverage. I personally have not run into this problem of once you go to actually use the policy that it's no longer, the company is no longer in effect. I'd be happy, Sean, to take a look at that with you if you want to reach out to me directly. But there are protections in place.
Great, good to know. Susan wants to know, can you talk a little bit more about care coordination benefit that may cover services by aging live care managers? She states that she knows that some policies provide like a yearly benefit. As a care manager, this can be a benefit that can help clients with assessment of their condition and additional support.
Sorry, I didn't.
So the question is, can you talk a little bit more about care coordination benefits that cover services by aging live care managers? Do long-term policies cover those types of things?
I'm not familiar with that. I think my experience with these policies is from the consumer side, and I'm working with clients who have purchased these policies and are trying to receive coverage under them. I apologize. I don't think that I can answer that question. I think it's more of an industry question for care providers.
Okay. Yeah, that's fair. And it might depend policy to policy as well. What about, we have another question here. Have you ever worked with any federal long-term care policies?
Yes, the federal long-term care policy program I have had clients who have had this coverage, and in my experience, it's been great. Customer service is great. There's nice benefits that are offered under it this is the program it's the nation's largest group long-term care insurance program. And so I think it has additional perks that others don't. And just in terms of the customer service, I was really pleased and satisfied with it.
Okay. What would you say to someone whose insurance company is offering to buy them out of their policy?
Good question. Tread lightly. The insurance company they've run the numbers, and they think it's more advantageous for them. They think they're going to save money by offering the policyholder a lump sum now rather than paying out benefits later. I would be really cautious about doing that. Also, if it turns out that if you need long-term care and you try and buy a policy again, you certainly may not qualify, or it may be too expensive. You'd certainly be older now than you were when you purchased the policy. So don't jump on it.
Very good points. Very good points. We got a couple more questions, and just a reminder, if anybody wants to ask a question live, we can take it in our chat box. So just go ahead and type that in. Here's a couple more. Can you use a long-term care policy for assisted living and home care simultaneously?
Yes, in my experience, that's been the case. Under the federal program, yes, you can do that. And certainly under the pooled benefit policy, where the per diem rate is paid out for any covered service, Yes.
Awesome. Is there a way to bypass your 90-day elimination period?
Yeah, that's what I had mentioned earlier. Once you're eligible for benefits under some limited policies, the waiting period will not apply while you're receiving respite care, hospice, or even caregiver training. So the services are covered, but they're not going to count towards meeting the service day waiting period requirement.
So what about out-of-pocket expenses paid out during elimination period? Will those be reimbursed retroactively, or are those non-reimbursable?
Covered.
They're covered. Okay,
Yeah.
got it. Got it. That's good. Last question that I have right now is, if you miss a payment due to illness, you touched on this earlier, if you miss a payment due to illness or forgetfulness, so like what if your client is put into the hospital, they miss the payment, can the policy be canceled? How long do they give you?
It can be, but they've got to give you notice. So they've got to give you time to cure it. Usually about 30 days after the payment is missed, they'll send you written notice and you can correct it. They'll notify you and your designated person 30 days before terminating it. So yes, it can certainly be terminated, but there's protections in place there.
Gotcha. Well, that is the last question that we have. Ariane, I think we'll turn it back over to you.
Yes, Jenica, thank you so much for your time. And Bree, thank you for running our Zoom so smoothly. God knows if I had done that, I would have screwed it up. And so just to kind of reiterate, once we kind of close this out, we will send a recording to everybody just so you can kind of reference what Jenica's slides previously, and then I'll get with Jenica after, and we'll add kind of a resource guide that she had mentioned. I know I took some notes about like the Maryland statutory power of attorney sheet. I think that I know a few clients that it's really important. So thank you guys for coming, and I know today's crazy for all of us, so we're gonna get out of here about 20 minutes, just shy of 20 minutes ahead of schedule. So thank you so much, Jenica. Thank you, Bree. Thank you, everybody, for being here.
Thank you.
All right.
Bye-bye.
Bye, guys.